Hello, investors. Welcome to Business Learnings. Whenever you invest in a business, you would always want to know whatever money you have put in, how much return will this business generate on that money, right? Whenever you want to invest in a stock, you must look into this parameter, which tells you how much return that money that you put in the business will generate, right? And that parameter is determined by two very important metrics: ROCE and ROE, return on capital employed and return on equity. Whenever you buy a stock, you look at the market cap, you look at the current price of the stock, you look at the P ratio, which tells you how much expensive that particular stock is. But many a times, people do not look into these two important ratios: return on capital employed and return on equity. And these are the ratios that I'm going to talk about in this video. I'll explain it in layman terms. Uh, let's say I'll give an example, and this will be very easy to understand. Then let's say you want to start a business, right? And you have about 1 lakh rupees of capital with yourself. You put in that 1 lakh rupees of capital and start the business, but you also need some more money. So you go to a bank and you borrow 1 lakh rupees from there. But the bank says that, I'll give you 1 lakh rupees, but I'll give you 1 lakh rupees of loan, but I'll charge you 10% yearly interest on that, right? So your initial capital becomes 2 lakh rupees. And out of this 2 lakh rupees, your equity, right? Your equity is 1 lakh, your debt is 1 lakh rupees. Now, next year, let's say you generate a profit of about 60,000 rupees, right? From this 60,000 rupees, you will pay so this 60,000 rupees of profit, this is calculated after subtracting the cost of your raw materials, your employees, or electricity, whatever you are consuming, right? You have subtracted all of that and you have arrived at this number, 60,000 rupees. Out of the 60,000 rupees, you will have to pay 10,000 rupees to the bank. Remember, the bank said that you will have to pay 10% interest. So you'll have to pay 10,000 rupees to the bank. Your net profit becomes 50,000 rupees. Now, the net profit, 50,000 rupees, divided by the initial capital that you put in, the initial capital that you had put in, which was 1 lakh rupees, not the total capital of 2 lakh rupees, the initial capital that you had put in, because that is the initial equity. So 50 by 100, that is 50%. 50% will be your return on equity. And your return on capital employed, it will be your the returns that you generated, which is available for you as well as your bank, which is 60,000 rupees. 60,000 rupees divided by your overall capital base, including your equity as well as debt. So this turns out to be 60,000 divided by 2 lakh, which is about 30%, right? So these two parameters, this is how you calculate a very brief primer on ROCE and ROE. And the reason that these parameters are so important, that is, whenever you invest in a business, you always want to know of each rupee that you put in that business, how much money that business is going to generate, right? Now, another important thing that you should note is, uh, when should you use ROCE, when should you use ROE, what are very good numbers for these two parameters, what is the threshold that you should be looking at. So we'll be covering all these things. Uh, Let me give you the example of Nestle India Limited, a very popular company, clean governance, disclosure. I hold it in my portfolio. Let's talk about Nestle. So, if you look at the balance sheet of Nestle, you know the balance sheet. Look at these two heads: share capital and reserves. 1923 plus 96, approximately 2,000 crore rupees. 2,000 crore rupees is the equity value of Nestle. And just scroll down to check out the borrowings. So borrowings is 147 crore rupees. So similar to our example, we had an equity of 1 lakh rupees and we had taken a loan of 1 lakh rupees from the bank. Here they have an equity of 2000 rupees, 2000 crore rupees, and they have a borrowing of 147 crore rupees. Similar to our example, in our example, net profit was 50,000 rupees. If you are finding it a trouble to recall, I would say that please rewind the video, watch it again from the beginning. So in our case, the profit was 50,000 rupees, and in Nestle's case, it is 2,159 crore rupees. So for Nestle, return on equity will be 2,159 divided by 96 plus 1923. This comes out to be slightly more than 100%. And if you look at the ROE of Nestle, this is about 106%, which is close to our estimation. And similarly, ROC will be calculated. Now, coming to the question, when should you look into the ROE and when should you look into ROCE? So you should be looking at ROE when there is little to no debt on the company, right? And you should be looking at ROCE when the company has a decent amount of debt. How will you determine it? Just look at the debt to equity ratio. If the debt to equity ratio is more than 20% or more than 0.2, ideally, as a rule of thumb, just make sure that you check the ROCE as well, because ROCE tells you the return on capital employed, the return on the overall capital employed, right? Not just equity, but also debt. And if debt is a significant portion of your capital, you must look into the return on capital employed also. What is a good number? A good number for ROCE, it hugely depends upon the industry. For example, Nestle India Limited, it belongs to the FMCG industry, fast moving consumer goods. They tend to have very high ROCE because they quickly, for the same amount of capital, they'll sell out their entire inventory. They'll manufacture and they'll sell it out again. They'll manufacture and sell it out again. The movement of goods is so fast that for the same amount of capital, uh, they are able to do sales about 10, 15, 20 times a year. And that's why their ROCs are very high, their ROEs are very high, right? So it's a completely industry dependent parameter. But as a rule of thumb, you should always ensure that return on capital employed should be more than 15% in ideal cases. Now here is a catch. Here is a catch between with ROC and ROE. The catch is you should always be looking into the profit and loss statement. In the profit and loss statement, if you scroll down, this is screener.in, um, you will see that there is a dividend payout percentage. It tells you of all the income that the company has generated, the net profit the company has generated. Where is it, the net profit? uh, Here it is, the net profit, 2159. Here the dividend payout ratio is not given, so I'll take the example of the previous year where the profit was 2082, and about 93% of the profit was paid as dividend. So just 7% of the capital is remaining. On this 7% of capital, even if Nestle generates more than 100% of returns, 7 becomes 14. So this is not a very good kind of a growth. So always look at the dividend payout ratio. If the dividend payout ratio is small, even a smaller ROC, even a smaller ROE is very effective. But if the dividend payout ratio is very high, it means that the company is not reinvesting its business at all. And in that case, even 100 or 200% of ROCEs will not matter much, because the company has doesn't have much prospects to grow, right? So this is a dividend payout ratio is very important to check while you are considering ROCE and ROE. Now, another important thing that you should be, this is the final point, by the way, whenever you are looking at ROCE or ROE numbers, make sure that you look at those numbers. You look at the historical values of those numbers. The numbers should be consistent. Consistency is the key. It shouldn't be that first year the ROC is 50%, next year the ROC is minus 25%. No, that will not work. So I hope the funda was clear. Please put down your questions in the comment box below if you have any. And thanks a lot for watching this file. See you in the next video. Bye.